welcome us all to this event, which had been scheduled for a while, and we thank God that we picked the date, and this event is coming up today, right now, and with our members in attendance, and our two wonderful, resourceful real estate experts that we've engaged, and they are here to share their wealth of experience with us, in person of Mr. Wale Johnson and Ms. Jane Eke. Please, we appreciate your time, everything, for being here, and we believe our engagement will yield a lot of great things at the end, and we believe we're going to learn and share so many things with you in this event. For our members, we believe other members will still be joining us along the line, because we are far, far more than this. We want to try as much as possible to keep to time, considering our guests that they also have other engagements. There will be time for question and answer, and we'll try to limit and stick to specifics so as not to labor our guests. And I believe we're going to have a wonderful time. Thank you.
The first person I'm introducing to us here today is Ms. Jane Eke, BMO mortgage specialist, professional to the core and a specialist who has closed countless deals by assisting buyers, sellers, and investors to get mortgage finance in the real estate industry. Ms. Jane Eke bags BASc in physiology and has been a mortgage specialist for over 10 years. She currently works with the Bank of Montreal as a mortgage specialist. The unique thing about Jane is that she is accessible, hospitable, compassionate, and a good listener, with an unbeatable ability to get buyers, sellers, and investors soft landed. So I have a singular honor and privilege to welcome you, madam. Second on our list is Mr. Wale J. Johnson, a real estate advisor. Raised in a real estate family in Calgary, it's clear the apple did not fall far from the tree. Wale J. was groomed to sell real estate. In his unwavering passion is evident to the many clients he serves. With over 15 years of experience working with buyers, sellers, builders, investors, Wale J's positive attitude, integrity, energy, and creative service has made him a consistent top-producing realtor. His ability to facilitate smooth real estate transactions, employ peace of mind, and an enjoyable experience is his ultimate goal. Whether you are selling your first property, investment, or commercial property, it is a huge decision. Your next move can be one of the most rewarding or one of the most stressful experiences a person can have. Wale J is your trusted real estate advisor and will guide every step until the job is done. On behalf of executive and members of Odua Progressive Union Canada, I have the singular honor and privilege to present you a realtor par excellence, Mr. Wale J. Johnson of Malcolm Homes and Real Estate. You're welcome, sir. I will be going to the next item on our agenda now, and that is calling on Ms. Jane Eke to dish out what she has for us in the first course for today. You're welcome.
Thank you. Hello, everyone. Thank you so much for joining. It's amazing, amazing seminar today. So I'm going to be talking about mortgages because that's my industry, right? And also I want to say thank you for Mr. Speakers, the coordinators, for having me on this amazing team. So I'm so excited to be part of it. I've been, just like what he said, I've been doing this business for 11 years. And I'm so happy of sharing my knowledge. So what we're going to be talking about today is, sorry, someone is helping me to share this, to share the screen. So please, can you just go up a little bit? Yeah, keep going. Yeah, awesome. So I'm going to be talking about home ownership. 6 easy steps to home ownership in Canada. Here we have real estate agent versus mortgage agent. This is what I'm going to be sharing. I'm also going to be sharing credit bureaus. I'm also going to be sharing down payments. I'm also going to be talking about investment properties, which is rental income, and also how to take equity out from your existing property if you're looking to invest in real estate market. I'm also going to be talking about group rental properties as well. And I'm also going to share term fixed versus variable. So these topics are very important. If you're a first-time home buyer, or you're investors, or you're second-time home buyer, this would definitely apply to you. So let's talk about real estate agent versus mortgage agent. So what I mean is, if a first-time home buyer, when you're looking for a home, the first person to meet will be mortgage agent before the real estate agent. The reason why is because it makes your life easier, and also makes the real estate agent's life easier as well. Why? What do I mean life easier? So let's put it this way. So as a first-time home buyer, first step to take, meet a mortgage agent, or you can walk into the branch or walk into a bank and ask for a pre-approval. So what that pre-approval does for you is it gives you the sense of to know, okay, this is how much I should be approving for. That way, when you get into the market, it's easy for you to win that property. As in, meaning it's easy for you to get that offer. I've seen a lot of examples, like I've dealt with a lot of clients that I've seen the different, those that came to me first and those that didn't come to me, they went straight to the real estate agent. And what I've noticed is those that got the pre-approval, okay, the transaction worked so easily, like it was so easy breezy out. And then those that went to the real estate agent, it was a little bit tricky because there was a lot of going for them back, or the you can't qualify, the purchase price is too high. So it's always advisable as a first-time home buyer, please visit your mortgage agent to qualify you for a mortgage. Okay, it's very, very important. That should be your number one goal. Visit a mortgage agent to qualify you before getting into the market, because that will make your life easier. So now let's talk about credit bureau. So as a first-time home buyer, and when I mean first-time home buyer, so first-time home buyer are those that are buying a property in Ontario, or let's say in Canada. So they are called first-time home buyers. You can own a property in US, it doesn't matter. You can own a property in Nigeria, it doesn't matter. But when you're in Ontario, when you're in Canada, you're a first-time home buyer. If you've never owned a home, you're a first-time home buyer. So as a first-time home buyer, it's very, very important to establish a credit. It's very important to establish a credit. So what I mean credit, like a credit history. Please, can you move it a little bit off so people can see? Yes, thank you. So it's very important to actually have a credit in this amazing country of ours. If you don't have a if you don't have a credit history, it's a problem. You know why? Because the bank will not be confident in loaning you such a huge money. So it's always important, if you're new to the country, go to any bank, tell them that you're looking for a credit, that you just want to get a credit card. And I'm definitely sure that when you ask for a credit card, they will not penalize you. I think they will definitely give you credit. Even though you don't have a job, because I've seen some people when they're new in the country, they'll say, oh, I don't have a job. I don't know if they will be able to give me a credit. Still, give it a try. Tell them, you know what, you will be the one to pay for that credit card. So there's a way they do it. You put your money, they'll give you a credit card, but the money will be your money. So it's not going to be their money, just for you to establish the credit. So when you start working, then you can start applying for credit card. And when you apply for credit card, please, and you get the credit card, start using it. Because I've seen some clients, they have credit card, they don't want to use it. They tell you, oh no, I don't want to waste it. I don't want, I don't want to use it because I don't know if I'm going to remember to pay. Trust me, your credit in this country, it's I don't want to use your life, but there's so much advantage of it. I've seen a lot of people that have a great credit scores. Banks are just giving them loan that they don't even want. They give them, they'll tell you, see, bank can give you a personal loan of 50,000 or 100,000 just because of your credit. You have an amazing credit. So please establish your credit. So it's very important to have your credit history established. And also, when you get a credit, please try to make your payment on time. Avoid late payments. It's very important. Because remember, when you have a late payment, that will impact you in purchasing a home. What I mean is, it may not impact you that badly, but you may not get that benefit. So you might end up going to a private mortgage or a B lender or alternative lender, and you may not even qualify for 5% benefit as a first-time home buyer. So please, your credit is very important. So please try to establish your credit in Canada, and also try to monitor your credit. Avoid late payments. Avoid high credit views. What I mean high credit views is, you have a credit card, you were given a limit of credit card of $10,000, and then you've already used $9,900. That's a high credit use. And trust me, it can bring down your credit score. If your credit score is like 700, you'll be amazed that your credit score will drop to 690. Or what am I saying? Or probably 650. And then you'll be wondering, well, why is my credit score low? It's because you've gone above the minimum usage that you should go. So try to minimize high credit use, and also avoid too many credit requirements in a short period. Always remember, when you go from one bank to another, shopping, credit, how do I put it? Credit, bank one will put your credit, bank two will put your credit score is going down. Or maybe some people use mortgage agent. Mortgage agent will put your credit, and the other bank that they apply the mortgage to will put your credit will go down. So avoid too many credit inquiries, because this will impact you in getting a mortgage loan. And I've seen this happen many times. And also avoid collection. I'll give you an example. We have there was this doctor that I was dealing with. He makes good income, but his credit was so bad. When I mean so bad, so many collections. And I asked the doctor, I said, you make good income. Your income, you make almost $300,000 to $400,000. So what is going on? Why do you have so many debts? They say, oh, don't mind those guys. They give me some bills that I don't want to pay, and I want to punish them, and I'm not going to pay that bill. So I'm like, okay, who are you punishing, them or you? Because at the end of the day, they report that to the credit bureau. And when that is reported, the banks will be scared to give you money. And it was a difficult deal. Like, it was a very difficult transaction. He has almost 6 collections. So please avoid collection. Collections are not your friends. When you have that collection, even Rogers, Fido, they're all bad collections, because some of them, and they really know, they use that against first-time home buyers, especially those that are new to Canada. They know that when you don't make their payment, when you don't pay them on time, and they ask you to pay, you don't pay, they'll take it to credit. They will take it to credit bureau. They will take it to Equifax, actually. They'll take it to Equifax or credit union or TransUnion, to say, oh, you're owing them, and then that will drop your credit score. So please, your credit, it should be your number one priority if you're looking to buy a home in Canada. This is not just for first-time home buyer, to anybody, even for investors. Your credit should be maintained very well. I know why I'm saying this, because I've been a testimonial on it. So when you have a good credit, you will have a good money. They will give you good money. Thank you. Can you go then? So I'm going to be talking about, thank you. So after your credit is good, now we'll talk about your savings, seven for your down payments. I know that majority of us, when you're looking to buy a home, you have to plan, right? So this is where you now determine how much you need to save towards your property. So remember, that pre-approval you got, let me use it as an example, that you got the pre-approval from me for $500,000. I would have actually had that conversation with you to let you know how much you needed to qualify for this mortgage that you're looking at. So I will always advise, as a first-time home buyer, plan, have a budget. What is your budget? How much are you looking at? How much are you looking to put down as a down payment? And also, that down payment that you're going to put, it has to be in your account for 90 days. 90 days history, it's very important. If that money is not in your account 90 days prior to you purchasing a home, then you have to let us know where that money is. I've seen a lot of past clients, especially our community, when it comes to down payments, they're not very, I think there's something missing there. So try to save towards your down payment. Avoid large deposit into your account. If let's assume you're buying a home. Let's use an example. You're buying a home. You're looking to buy a home in January. That means you've already saved from October, November, December. There's a history of $50,000 in your account. And that money has been there. There's no large deposit. Because sometimes when I ask clients to show me their down payment, they show me a history of their down payment. Oh my God, I see $20,000 deposit. I see $1,500, $1,600, $2,000, $5,000. In under 3 months, there's so many transactions. That is a killer. Then there's a problem, because the bank will be like, we're not comfortable in giving this person a loan because there's so many transactions going on. We don't know if this is a money laundering. So their mindset goes to money laundering. That's what they just think about. Oh, this is money laundering. Even though it's not a money laundering, So avoid large deposit into your account. And if there is a large deposit, okay, then we have to present that large deposit as a gift, So that is very, very important to look into before buying a home. Your down payment matters a lot too. That's what majority of the banks in this country look at. They just want to know that that money was saved. That they just want to know that that money was saved prior to 90 days. So also, as a first-time home buyer, I think there is other options. You may not want to go to 5%. You can also do 20% down payment. If you don't want to go to if you don't want to do like a high ratio mortgage, meaning if you don't want insurance to be part of the mortgage, you can do 20%. Okay, so here I'm just going to touch point on the benefit of 5%. Okay, so benefit of 5%, you can obtain a insurance premium, and the amortization period is 25 years. Also, benefit of 20%, you can extend your amortization period to 30 years. So what do I mean by that? So let's assume you put a 5% or you put a 10%, 20%, okay, towards your mortgage. And sorry, no, I mean 15% towards your mortgage. So that means you need insurance. This is where insurance comes in. So I will talk about the insurance in another slide, but I just wanted to just give you a little bit brief about, about the down payment. Yeah, so I talked about the benefit of 20% that you don't need insurance, and I also talked about the 5%. Then when you go with 5%, your amortization period will be 25 years actually. And also I talked about the 90 days history, which is very important, towards saving towards your down payment. So it's literally very good to have that 90 days history. That will be able to help you to purchase your first home, even your second home in this country. And I also said anything that is large into your bank account, that has to be explained to the lender. So to whoever your mortgage agent is, that maybe if it's 20,000, you just say 20,000 is a gift. And also remember, the bank, financial institution do not accept gifts from uncle, auntie, brother, auntie. They only accept gifts from immediate family, which is your brothers and your parents, that the gift is acceptable. Please, the next screen. Okay. Yeah, so just like what I said, when you're looking to buy your first home, start early, save regularly continuously. If you don't know how to do that, you can go to the bank and talk to one of the financial planner there. This is their job. You just tell them that you're looking to save towards your down payment, and they will give you step, but they'll work with you and give you that step to follow in purchasing your in saving towards your down payment. And trust me, guys, it doesn't have to be in your savings account. Your down payment can be in your investment account as well. But just remember, if your down payment is in your investment account, make sure that it's not in an RRSP. That what I mean is not in an RRSP account in a way that except you're a first-time home buyer. But if you're investors, don't put if you're looking to use that money, don't put it in your RRSP account. Put it in where you can literally take the money out, like GIC. So that I'm going to stop there. So let's go to the next slide. Yeah, so remember, guys, I was talking about 5%, 10%, there's no 3%. I wish there's 3% anyway, but there's no 3%. 5%, 15%, 10%. So these guys are called Canada Mortgage and Housing Benefit for Canadians. So in Canada, we have 3 mortgage companies that insure mortgages to every home buyers. So we have CMHC, we have Sedgwick, we have Canada Guarantee. You see these guys here? They are like a police. They are like, how do I put them? They are so attached to their guidelines and with the regulation in this country when it comes to a home buyer. So sometimes it's so tough to penetrate to them. So that's why we have to have a clean credit history. If we're going to go with these people, meaning that we're going with them to ask for 5%. So let's assume you don't have 20% down payment. You only have 5%. You only have 9%, 6%, whatever percentage you have that is not up to 20%. We have to follow their guidelines. You know, these guys are our guidelines, even with the bank. Sometimes with the bank, we say, yes, we love this client. We want this client in our book of record. And these people will say, oopsie, sorry, we can't help you guys. And at the end of the day, if they say no, then the bank will say no. The only time the bank can say yes is when you're putting 20%. That means we don't need these people. We don't need CMSC or SAGI or Canada Guarantee to represent, to help you on your on the loan amount. So the insurance, I'm just going to read through. So mortgage default insurance is arranged by your lender when you apply for a mortgage. Your lender will submit a mortgage default insurance application on your behalf and can walk you through the basic criteria required. So meaning how much does it cost? So the premium range from 0 to 4% of the loan amount, depending on the size of the loan and the value of the the value of the home. So I just did a little calculation there to just, to give you guys how this is calculated when we're working towards the mortgage loan. So let's assume that your mortgage loan is $500,000 and you're putting down 5%. So this will be the calculation, 500 times 4%. That will be your insurance. You see the insurance you're paying there, $20,000. So this is how we now do it on the banking side. So we'll now add that $20,000 on your mortgage loan amount. So that will be like $520,000. So some people will say, you know what, Jen, I think I have just $20,000. There's not even need of you adding that on your mortgage. Good. You can pay that off. Some people may say, no, I want that to be added to my mortgage. So majority of the people that I've worked with throughout my years experience, they all add that towards their mortgage loan. Okay, so this is where your mortgage loan amount comes in to be $520,000. Please, next slide. Okay, now we're going to talk about rental investment properties. And I know in this, in the chats, the seminar today, I know we have a lot of people in the rooms that have property already in Canada. So just in case you're looking to invest in a rental property, I think this is the method. So here, let's talk about equity takeout. So equity takeout is refinancing your existing property to put towards your down payment, okay? And also we talk about group rental properties, minimum 20% to 30%, depending on the size of the mortgage loan. And pick few people. So I'm gonna talk about this one, that the business, the group rental, but let's talk about the rental, the first one, the equity takeout. So I'm going to give an example. You're a homeowner. You have a home in Canada. The home has built an equity. So let's assume your equity is like you've had this home for 5 years or going to almost 10 years, and you have so much money in your equity, and then you're looking to take advantage of that money that is in your account, in your property, to purchase another property. So this is where the refinancing comes out. So it's called refinancing. So meaning you're refinancing and you're taking money off to buy another property. And you can use that towards the down payment. There's no problem, because remember, you don't even need to show the bank 90 days bank history, because the bank knows that this money is coming from your equity. So this is where whoever your mortgage agent is, please guys, deal with mortgage people that have experience, because I know in this country we have so many mortgage brokers, so many. Probably the people that just got their license for the fun of it, people that just got their license because their friend told them about it. You need to do with someone that has the knowledge. If you meet a mortgage broker, trust me, go to their page, go to their LinkedIn, go find out about them, because why I'm saying this is very important. Real estate agents don't have their job is just for them to show you a home. But mortgage broker can make your deal die and you will lose so much money, or they can make your transaction go well and you don't lose a dime. I've seen a lot of clients. Last minute, they come back, they cry. My money is going, $80,000. I'm going to lose it just like that. So it's very, very, very important to work with a mortgage broker that have knowledge, that know what they're doing, not to just get the license for fun. So going back to what I'm saying on the equity, so the mortgage broker have to let the bank know that you've already refinanced your property and the large money that is in your account, because when you refinance, you take that money out, the money goes into your account, let's say $100,000 or $200,000. There's no history. There's no history to show there's $200,000 in your account. So this is where you now have communication. You have to communicate with your mortgage broker to say, hey, this money, this 200,000 came from my equity, and please let the bank know. So the bank will now ask you, okay, that's fine. If that money came from your equity, they want to ask you your mortgage statement. They'll ask you your mortgage statement to prove that. So now let's talk about and as an investor, looking to buy a rental property, you can own 2 to 3 properties in this country for sure. And then let's talk about group rental properties. I've heard about this group rental properties. So when I mean group, maybe minimum of 5 to 6 people looking to buy a home. They put the money together, and they can put, actually the minimum they can put down is 20 to 30%, depending the size of the mortgage loan. So so let's assume if you guys are coming in a group and you're buying a home of 1.2, 1.3, you can put 20% down, of course. The bank will let you guys put that money. But just like what I said, depending the size of the mortgage and depending also the size of the income. So, and remember, in that group mortgage, let's say if you guys are 5 or 6 people that are looking to buy, 6 of you will not be in the mortgage. Just to give you guys heads up, 6 of you will not be in the mortgage. No, but 6 of you can be in the title. You can be in the title of the properties. Of course, your money was contributed to it. So in that group, you guys will not pick the person that have the perfect credit, that have the perfect income, that will be able to qualify for that mortgage loan amount you're looking at. So what do you know what I mean perfect? No collection, you don't have a bad credit, you have a good income. It might be 2 to 3 people that have that. Yes, we can use 3 people to qualify for that mortgage loan amount that you guys are looking at. Then the remaining other people can be on the title. So this is where you guys would have to work with your lawyer. So, to group you guys into that title, into the property title. But on the mortgage, no. At least in the mortgage, we need minimum of 4 people. Like me, when I'm doing group mortgages, I ask questions. I say, how many are you guys? They'll tell me probably there's 7. I said, well, sorry, guys, you have to pick. So people just say, you know what, 2 people can be on the mortgage. Okay. Yeah, just like what I explained. So pick few people, like minimum 4 people who can qualify for the mortgage loan. Please, next slide. Sorry, I'm trying to put the time. Yes, so this is very important. Term fixed versus variable. This is very important because I'm doing this presentation to another Nigeria communities now. With the market that is going crazy, a lot of people are confused, especially those first-time home buyers, and also some of us that own properties as well. Like the variable rates are going up, the fixed rate is unbearable. So I'm just going to give a little bit brief about term fixed and variable. Right now with this market, I would definitely, my opinion would be I would advise for variable rate because they are the lowest. Fixed rate has gone up now. Fixed rate is minimum in my where I work bank. I work for the BMO Bank of Montreal. Fixed rate has gone to 6%. So if the banks rate, the 5 banks, I don't know about the other banks, but I know my bank that's gone 6%. So you can imagine alternative lenders. Probably alternative lenders are like the Home Trust and Equitable Trust. Probably their rates will go like 7 to 8%. So right now with this crazy market, I will advise that people should attempt to stay around that variable rate to minimize your payments. So here I'm just going to read. So variable 5 years close versus variable versus 5 years fixed rate. So as per the current market, most 5 lenders have 5 years close mortgage. And so what I mean that 5 years close mortgage means 5 years variable close mortgage. That's what I wanted to say that. So for lenders, if your rate increases, your monthly payments stay the same. So sorry, I just need to wrap up this. So when it comes to 5 years variable rates, there's 2 types of 5 years variable rates. They have 5 years variable close, and they have 5 years variable adjustable rate. So 5 years variable close means those ones that have that mortgage with A banks. So A banks are like CIBC, RUBC, BMO, Scotia. There's another bank. I think we're 5. That's 5 banks, right?
TD.
Yeah. TD. Thank you. Yeah. So those guys, majority of their variable are 5 years fixed, 5 years variable close. Why other alternative lenders that I've lent recently that they have adjustable variable rates? So I'll use myself an example. So I have ROBC 5 years variable close, and I have Simply is a CIBC, but they're under CIBC. So they call those ones are alternative lenders. And the rate they gave me there is 5 years variable adjustable. So meaning the 5 years close, if interest rate goes up with ROBC right now, my interest rate goes up. But the monthly payments still remain the same. So if I'm paying $750, I'm paying $750. Okay? The only thing that will happen, the benefit, the disadvantage of that is that $750, majority of the money will go towards the interest, and less will go towards the principal. Why the one that I have with Simply, as Simply rate increases to 2.54, my monthly payments is increasing at the same time. You know, and then I'm like, oh my God. So this is where you're like, oh, what's going on? So I find out that there's 2 different types of 5 years variables. So 2 types of variable rates, which is adjustable and close 5 years rates. So please, when you get those kind of rates, let's assume that you went into purchase and you got a variable rate, please ask questions with your mortgage brokers. Ask them, what are you giving me? Is this 5 years variable close? If interest, just ask as much questions as you can ask, because a lot of people are being impacted right now with the increase of variable rates. It's crazy. I've had so many clients that went through the alternative lenders. They are all worried because of the increase. I used to pay $2,500. Now my monthly payment on the adjustable rate has gone to almost $3,000. So this is where a lot of questions have to be asked through your broker. So you ask your broker, please, I need you to explain to me 2 types of variable. And fixed, those that are locked up in fixed 2 years back, I think they're smiling. But right now, fixed has gone up. So do not go lock yourself in 6%. Of course, I'm looking at the market, it's crazy. Of course, the inflation is too much. There's so many things going on, but the market will not remain the same. It will still come down. Yeah, so it would be nice to have that conversation with your broker. And then, I don't know, I think that should be the last slides, right? Yes, awesome. So that's fine. Thank you. So I'm going to talk about your closing. So once you've, getting approval from your mortgage broker, you're good to go, everything is smooth, you've spoken to your lawyer, then we'll now talk about closing costs. So closing costs. In Ontario, closing costs required for you to finalize your mortgage is 1.5%. So what I mean 1.5% is, remember, let's assume that you're putting down, okay, no matter how much you're putting down, so you're putting down 50,000, you're putting down whatever, The closing cost, the bank will calculate the closing cost. So the closing cost will be 1.5% of your purchase price. That will be what the closing cost is. So the bank will calculate that closing cost. So how is that calculated? So let's assume that you purchase a property of $500,000, and then you put down $50,000, which fine, and then you got your approval, everything is good to go. Remember, before your approval, the bank would have found out that you have enough money to cover the closing costs. So let's assume, okay, we'll just do this math. I just wanted everybody to be on the same page with me on this, okay? It's very important. I've been seeing a lot of errors with this. So let's assume that the purchase price is $600,000, okay? And then, you know, you got a mortgage for, let's say, okay, let's use an example. So times 20%, you put down 20% minus $600,000, right? So the bank will expect you to have, so 600 times 20%, 120, right? So the bank will want you have, remember your down payment of that 600,000 is 120, right? So now the bank will want you to have more than 120. So this is how they will calculate it. They will now say, okay, 600,000 times 1.5% plus 120. So they want you to have $129,000 into your account. They want to see that money. You know, they want to see that money, you have it to be able to finish, to be able to cover your closing costs. So then when the calculation they use is 1.5. So it's very important to have that conversation with your mortgage broker, because at the last minute, some of them were like, oh my God, I didn't know, nobody told me about closing costs. And also, I don't even know what is even in this closing cost. So guys, closing costs, things that are in there is land transfer tax, which your lawyer will do the calculation for you, title search, appraisers, all this, you know, transaction insurance, you know, so they're all part of closing costs. So the bank will want to see that money into your account before they give you a final approval. So when you're budgeting, budget your down payment, which let's assume you're putting 20% or you're putting 5% down, and also budget on your closing costs. Some people would say, oh, sometimes I tell my clients to just budget 2%, because the reason why you don't know what will happen during the closing cost, you don't know, sorry, during the closing, during the transaction, you don't know what will happen. You might need more money, depending. So I think that's where I'm going to stop today. I think I've covered almost everything. So if you have any questions, please, please, please let me know. I am still here to the end of the event. And I just want to say thank you so much, guys, for giving me the opportunity to share. I know mortgage business is really broadened, like there's so many things to cover, but I just picked the ones that are very, very important for me to share with everyone. So thank you. Thank you.